Yogah Karmasu Kaushalam.
I'm Dr. Sweety Shah, and I thank UGC Human Resource Development Center of Gujarat University for giving me an opportunity to connect with you all and deliver my session on risk and return. I also thank Dr. Jagdish Joshi, Professor and Director of UGC Human Resource Development Center of Gujarat University for providing this opportunity. We all in the team have developed lots of content on different subjects for students and faculties. Human Resource Development Center, Gujarat University is ranked as 15 in India and number 1 in Gujarat. It is pioneer and has created benchmark by organizing the first of its kind online refresher course in India in the year 2018 and 19, where about 2,500 participants have attended it, and the first online professional development program for the administrative staff of the university during the lockdown with 105 participants. Now, beginning with the topic risk and return, where I will cover what is an investment, the concept of risk and return, and the calculation of risk and return. Looking to the learning objective, after this session, you will be able to know the meaning and the types of risk and return, to understand the role of risk and return and valuation of return, and to study the various methods to evaluate return on investments. So beginning with the topic, what is an investment? In finance sense, it is a monetary asset which is purchased with the idea that the asset will provide income in the future or will later be sold at a higher price for a profit. So from an investor point of view, where the individual wants to make an investment in various alternatives, the prime objective will be wealth maximization. But this will lead to the series of the question in the mind of an investor like, will it be safe to make investment in the securities? What are the maximum benefit that one can derive from this investment? What type of the securities are more beneficial, either debt or equity? Which type of security one should buy? Or what are the growth trends followed by this security? Whether they're always going to grow or decline sometime. Above said few questions that may arise in the mind of an investor, which would be addressed in the coming discussion. So first of all, we will understand what is return and what is risk. The term return refers to income from a security after a defined period, either in the form of interest, dividend, or market appreciation in security value. On the other hand, risk refers to uncertainty over the future to get this return. Putting these things in simple words, it is probability of getting return on security. A higher the probability, which will lead to a certainty of occurrence of return. And contrary to that, low probability means there are higher chances of not getting return on investments, or it may be called as the situation of loss. So now it makes essential for an investor to study the risk and return characteristics of every individual security before making investment therein. Therefore, Selection and shortlisting of security may be made on the basis of risk and return relationship. The term risk refers to the possibility of occurring something unpleasant, undesirable, or unwelcome. It is a situation involving exposure to danger, loss, harm, or other adverse consequences to investment already made, or the future earnings, or their present holdings. So, from this point of view of an economist, risk refers to a state when actual outcomes are low as compared to the expected outcomes. This risk is a part of every economic transaction or the human endeavor. To understand this term risk in a better way, we are just going to look at the viewpoint of renowned authors. Like Frederick Crane has given the definition of risk as risk means uncertainty about future losses. Or, in other words, it is the inability to predict the occurrence or size of these losses. And this risk can be classified as pure risk or speculative risk. At the same point of time, one more definition which has been given by Emmett and Therese Wagon says that risk is a condition in which there is a possibility of an adverse deviation from a desired outcome that is expected or hoped for. Now, from this definition, the following characteristics can be drawn. Like risk refers to the chances or the losses or the uncertainty of occurrence of the return. It might be the possibility of an adverse deviation of expected income or its output. So that means while you are investing, at that point of time, probably when you are investing, your motive or your expectation of generating income is, say, suppose 10 percentage, but actually you are not receiving that 10 percentage expected return. So risk is always uncertain. If it is certain, then it can be treated as expense against the revenue only. Looking to this particular classification, now we are moving to the types of the risk. So generally, risk has been categorized, and the magnitude of risk is also going to vary from its nature and type. Thus, its impact on the return on the investment is also going to vary. So, the essence of risk in an investment is the variation in its return, and this variation in return is caused by a number of factors as well. These factors constitute the element of risk, and there are certain sources of risk, and these sources may be internal or they may be external. So based on this factor, there are certain categories of the risk are there. And these categories are actually based on the chance of occurrence, flexibility, measurability, coverage, behavior, and diversification. So due to the limited scope, we will discuss only the relevant type of risk in this session. The first category, which is based on the basis of occurrence, where the risk has been classified as pure risk and speculative risk. So these are the two types of risk involved in a risk classified on the basis of occurrence. The pure risk exists when there is uncertainty as to whether loss will occur or not. But there is no possibility of gain is presented by pure risk. So possible outcome are either it would be very adverse, which can be the loss, or neutral, which can be no loss. But nothing good can come from the exposure of pure risk. Say, for example, the damage of your property, okay, by fire, illness, job related accidents, can be the few example of this pure risk. On the contrast to pure risk, speculative risk, which exists when there is uncertainty about an event that could produce either profit or loss. So these are the risks which offer possibility of gain or loss. So business or investment trading risk falls under specifically under this category. Say suppose being an investor, you are making an investment in 100 shares of a company. Let's say suppose price 200 per share with prospect of increase in the prices up to rupees 250 per share after 3 months. But on the value date, the price of share falls below 200 to 180. So in this case, instead of earning, now you are suffering the losses, and these losses are rupees 20 per share. Another example of speculative risk can be a lottery. A person purchasing a lottery ticket at say suppose 100 rupees and he is winning the prize of 1 lakh. So over here, this person has definitely overcome the risk and his speculation has resulted into the gain. The second category of the risk, which is based on the basis of flexibility, where risk has been bifurcated into static and dynamic risk. So this is also another way of classifying the risk, and here the risk is the extent to which uncertainty changes over the time. Static risk remains indifferent in changing economic environment. So this risk would certainly occur even if there is no change which will take place in the economy. Say for example, risk of dishonesty of employees or some of the perils. But on the other hand, the dynamic risks are those resulting from the change in the economy. Say, for example, changes in the inflation rates, consumer taste, income level, technology changes, which are actually causing losses to the business enterprise. So this dynamic risk affect a large number of people, but with different degree. And this type of risk are difficult to predict even, as they don't occur with certain precise degree of regularity. Moving ahead now, the third classification of the risk, which is based on the basis of measurement. In the wildest sense, risk include all adversity, including financial losses. So this financial risk refers to the uncertainty which can be measured in terms of money. So there are three features of financial risk. One in that it would be there is adversity due to the occurrence of an event. It can be the asset or the income which is likely to be exposed to a financial loss from the occurrence of an event or the decline in the economic value of that asset or the property. And third, it may be there is direct relationship between the peril and its cause of losses. So here, all the losses are expected, and here you can quantify this particular losses so as your financial risk. On the contrary, the risk which cannot be measured in terms of money are called as the non-financial risk. The lack of the measurement is actually an incomplete proposition for such non-financial risk. But actually, such losses are so complex in nature. That's why they are difficult to measure. So, in an investment decision, whenever we are investing in the certain investment alternatives, at that point of time, this financial risk are important than non-financial risk. Next category, which is based on the basis of coverage, where risk has been bifurcated between the fundamental and the particular risk. So fundamental risks are those risks which tend to affect large number of society and the section of society, entire economy, large number of people rather than individuals. So the impact of particular risk is much restricted as compared to fundamental risk. For example, loss due to the terrorist attack. It can be considered as a fundamental risk because its a coverage would be much wider. On the other hand, the death of the member of parliament in a car accident is a particular risk. So the fundamental risk actually affects the market as a whole, and therefore it has very limited scope in investment decision. So the particular risk may be associated with an industry or a company, firm, or specifically to your investment option. Therefore, its a measurement and impact both play vital role in determination of rate of return that you are expecting from that particular asset class. Next category of risk, which is based on the behavior. And here the risk has been bifurcated into subjective and objective risk. Subjective risk refers to the mental state of an individual who experiences doubt or worry for the outcome of a given event. So the subjective risk is a psychological uncertainty based on the person's mental ability, especially the perceiving the different outcome of the identical situation. But this subjective risk perception have become an important factor nowadays in investment decision making. So the interpretation of the basis of certain behavior, the categories are there like risk taker investor, risk averse investor, or risk neutral investor, which is again play a vital role in the decision making. Whereas the objective risk is more precise, observable, and thus measurable as well. So, in general, objective risk is the possible variation of actual from expected experience. So, this term is often used in connection with the pure and static risk as well. It is also important to note that this objective risk is also based on the probability or the likelihood of occurrence of chance of exposure. And it is always calculated to determine the attitude or behavior of a person who is exposed to a various type and category and the level of risk. Next, bifurcation, which is on the basis of diversification, where risk has been divided into two categories, diversified risk and non-diversified risk. The most commonly risk which is used in investment decisions are diversified versus non-diversified risk. The diversified risk is also known as unsystematic risk, whereas non-diversified risk is known as systematic risk. In simple words, if we put the risk which is very much inherent in the system and cannot be separated from the system. Now, this system might be the organization, it might be the industry, or it might be the class of the securities. But it cannot be separated from the system. So it is called systematic or non-diversified risk. A risk, the level of which we can reduce or manage by diversifying our investment. It is called as diversified risk. Now, such risks are not rooted in the system and therefore they are known as unsystematic risk. Say, for example, the interest rate, recession in the economy, taxation policy, war, all represent the sources of systematic risk because they affect the entire market and cannot be avoided through diversification. This systematic risk can be mitigated only by means of hedging. So the systematic risk underlie all the other investment risks. So if there is inflation, investor can invest in securities in inflation resistant economic sectors. If interest rates are high, investor can sell the stock and move into the bond. Every security or holding of the assets have inherent bearing of the risk and which cannot be avoided through diversification. However, the other risks such as unsystematic, which could be reduced through diversification. Say suppose, just look at both. Here on the left hand side, we can see there are certain factors are mentioned. Now this particular factors, these are form specific. So here all the action and the risk are limited to form only. Say suppose the project would do better or not, it would affect your firm or the performance of the company. Competition may be strong or weak. Again, it is going to affect the business of the company. So these are the particular reasons are there, factors are there, which would affect your firm. And this particular risk are considered as unsystematic and you can diversify this risk. Coming to the right hand side, here somewhere you are finding that the entire sector may be affected by certain action. It's like the impact on the industry. But slowly and gradually, when we are moving to the right hand side, at that point we are finding that these are the particular factors. This would impact firm, this would impact markets as well. So suppose there is change in the exchange rate or certain political risk is there, it is going to impact the market. When the change in the interest rate is there, inflation is there, or the news about economy is there, at that point of time, this particular factors will have overall impact on the market. So this particular action or risk are going to affect all the investments. So this sort of risk are known as systematic risk or non-diversified risk. Just look at over here. Here, the x-axis, which is representing the number of sources or the portfolio. And here, the y-axis is representing the risk of your portfolio. Now, here you can see there is one parallel line to the x-axis, which is actually representing the systematic risk or the market-related risk. That means that whenever certain things would occur at that point in time, it is going to impact all your investment. And systematically, it is going to impact the economy as well. But at the same point of time, one line that you can see, downward sloping, it is actually representing the unsystematic risk, non-market related risk. This is business specific risk. This is firm specific risk. And this particular risk can be reduced. And how it can be reduced? So through the diversification. That's why when you are including more and more number of security or asset class into your portfolio, at that point in time, you are trying to reduce this risk, which is diversifiable in nature. Whereas this particular risk, which is systematic, you cannot diversify by just adding certain securities into your portfolio. I hope this concept is clear to everyone, that is systematic versus unsystematic risk. Further talking about this, what are the sources of the systematic and unsystematic risk? So another systematic risk, we generally include the market risk, the interest rate risk, and lastly, the inflation or the purchasing power risk. Now, what is this market risk? Market risk is actually caused by investors' reaction to tangible as well as intangible events. So the stock prices fluctuate due to the various reasons. So the frequency of this change in the prices may be high, or short in nature, or it would remain unchanged over the period of time. But a general rise in stock prices is referred as the bullish trend. And the general trend of falling the stock price would be referred as bearish trend. But an investor can record these changes from the share price indices or from the stock market. And there are various factors which would influence the market risk, which is ranging from economic to political, entrepreneurial to social. So the causes of this phenomenon are varied, but its magnitude depends upon investors' attitude. So might be the initial reaction or the signal of fear of losses or anxiety, but following the herd instinct, which build a situation that seems all the investor would exit from the market. Now, such emotional instability of investors collectively would lead to a snowballing overreaction. But the market risk is a major constituent of this systematic risk. The second risk is the interest rate risk. This risk refers to the uncertainty of future market values and of the size of the future income, which is caused by the fluctuation in the general level of interest rates. So the interest rate risk particularly affect debt securities, because this debt securities carry certain coupon rate. So whenever an increase in the interest rate would occur in the market, at that point of time, there would be the decline in the prices of the debt security, because the market interest rate and the value of your bond carries an inverse relationship. It means that if there is negative relationship, and at the same point of time, when the interest rates in the market are going to go up, at that point of time, the adverse impact is going to happen. For example, there is a debt security which is having the face value of 100, and this particular debt security is offering you 10% coupon rate, which was the prevailing interest rate in the market. Now, subsequently, there is a fluctuation in the interest rate in the market, and these interest rates are increasing to 12%. Now, in this situation, no investor will buy the debt security which is yielding 10% interest rate, as it is not sufficient to cover up the cost. So over here, this particular security would trade at certain discounted value. Now say suppose just because of now in the market interest rate is 12%, this debt security has been discounted and now it's trading at 80 rupees. Now this 80 rupees, that value that debt security has achieved in the market, this 80 rupees would give 12% return to the investor, which would be equal to the market interest rate. But the opposite would happen if in the market the interest rates are coming down, say suppose 8%. So at this point of time, the security, the debt security which is offering 10% coupon rate would become the attractive investment, and it would trade at premium value. So hence it is proving the negative relationship or the inverse relationship between the market interest rate and the prices of the debt security. But this is how it is going to impact your investments. The third risk is the purchasing power risk, which is also known as the inflation risk. Now, this basically refers to the impact of inflation on an investment. So, a general increase in the price level of goods and services would be called as the inflation. And the immediate impact of inflation is that it postpones the consumption. So, in investment management, also, investment in security is also considered as a consumption only, and thereby mean that an increase in the inflation rate would decline the purchasing power of investors as well, and vice versa. So this inflation risk impact not only the debt security, but also the equity market in the same direction by postponing the investments in the various markets and various financial instruments. Now, talking about unsystematic risk. Unsystematic risk are generally indicated by leverage of a firm. And these unsystematic risks include both business risk as well as the financial risk. Now, business risk is actually a function of the operating condition faced by a company and variability in operating income, which has been caused by the operating condition of the economy. So any increase in business operating income would lower down the business risk. And on contrary, the high fluctuation in the operating income over a future period amounts to uncertainty. It will increase the business risk. And since this risk is largely associated with internal investment and the return thereon, therefore, it is known as operating risk of the company or the business risk of the company. But at the same point of time, then what is financial risk? So this financial risk is associated with the financing activity of the firm. So company may have two type of security in their capital structure. Either it would be the equity capital or it would be the debt security. But as the number of the debt security are going to increase in the total capital, it is going to burden up the company with the interest on such debt security. So basically, the fixed claims are increasing or the fixed charges are increasing. And since the payment of the interest and the debt securities are mandatory, of course, so the amount which is remaining after such fixed charges is coming down. And when this profitability is coming down, it is actually reducing the earning per share or the equity share. So this is denoted as the financial risk. So in case whenever the degree of operating leverage, which goes beyond 1, increases to 1, it reveals it is the existence of operating risk. Similarly, a situation where degree of the financial risk is increasing to 1, it also indicates the financial risk. So the total risk of the firm from the perspective of the investment management is always the sum of this systematic risk and unsystematic risk. So total risk is denoted as systematic risk plus unsystematic risk. So these were the few category of risk. I hope you have developed a fair understanding of risk. We now move our discussion to return or income. The prime objective of making investment in any security is either to yield income on that investment in the form of dividend or interest or appreciation in the investment value. Return is the motivating force and the principal reward in the investment. An appreciation in the investment can also be considered as capital gain on investment. A rate of return on investment provides the basis for comparison among given alternative investment opportunities. So generally, when we look into the return, at that point of time, this return is having two components. One is current return and one is capital return. So total return is equal to current return plus capital return. Current return is a periodic cash flow or income that you are generating out of your investment. It is having a regular income nature. The current return either would be zero or it would be positive. So basically, when you want to calculate the current return, it is nothing but the cash stream or the cash flow that you are receiving during the year that you are going to divide by the beginning value of an investment. Whereas the capital return, it is reflected in the price change. It is simply a price appreciation or depreciation, the value at which you are buying the asset and value at which you are selling the asset. It is generally applicable for the assets which are marketable or the tradable in nature, like equity or the real estate. The capital return, either it would be zero, or it would be negative, or it would be positive. To calculate the capital return, you need to first calculate the price change in the value of the asset divided by beginning price. So return is equal to C plus PE minus PB upon PB, where C denotes your cash flow that denotes your current return in absolute values, where PE minus PB, it denotes the price change. So basically, this particular component is denoted as capital gain percentage or the capital appreciation, or in other terms we call it capital return as well. Whereas this particular calculation is going to give you the current return percentage. If you want to calculate the total return, let's understand with the help of timeline. Suppose you had invested in certain investments at the time 0 and your holding period is 1 year. So at the end of 1 year, the value that you are deriving from the market and the value in the form of dividend or the current return that you are fetching from that particular security, this two component would give you the rupees total return. And if you want to calculate in the terms of the percentage, you just need to divide that by your initial investment. Let's look at one example. You are investing 1000 rupees in a certain investment and your holding period is 1 year. After 1 year, you are selling that stock or your investment at 1200, which is a value higher than your initial investment. At the same point of time, over this 1 year period, you are also receiving the dividend amount 50 rupees. So what is your total return and absolute value? So it would be 50 rupees your current return plus the change in the value of your investment, which would be 1200 minus 1000, it is 200. So your total return or the income out of this investment after 1 year holding period would be 250. Further, let's see one more example. Suppose you are investing in one of the share and you are buying 100 shares of that company. Let's say suppose 45. Over the period of last year, you have received 0.27 dividend per share. So your total dividend here would be 0.27. Multiply that with 100 shares. At the end of the year, the stock you are selling at rupees 48. So here, what would be your total return? So you invested total amount of 45 rupees per share, multiply that with 100. So it's a 4500. At the end of the year, the value has enhanced to 4800 and the cash dividend that you are receiving, that is 27 rupees. So here your rupee gain would be 27, which is your current return and the difference between the price at the end and the price at the beginning, which would be 300 rupees. So overall, your total return in rupee value would be 327. If you calculate the percentage gain for this particular year, so that would be your total return, that is 327, divided by your initial investment, which was 4500. So here in the percentage, your return would be 7.30%. Now, two of the examples that we discussed so far, where we are having certain gain. But now we are going to look at one more example where instead of gain or instead of appreciation in the value of the stock or the asset, there is some depreciation in the value of the asset. So in this case, what would be the return? So here the example is there. We have been given, suppose one has bought a share of ABC Limited at 300 1 year back. Over the last year, ABC has distributed the dividend of 5 rupees per share. And if share of ABC sells at 280 today, what is the return? So as far as the current yield is concerned or the current return is concerned, as I mentioned earlier, either it would be 0 or it would be positive. So here also the 5 rupees per share dividend which we have been given, that will help us to calculate the current return. So it would be 5 rupees divided by your initial investment per share, which was 300. So here the current return value is 1.67%. But if we look at the values or the changes in the value of the asset, here after 1 year, the value has actually depreciated to 280 rupees, whereas the investment was 300. So here the loss of 20 is occurring per share. If you just calculate what is the loss or the capital loss for this investment, so it would be minus 20 divided by the initial investment 300. So here your capital return is actually minus 6.67 percentage. So if we just look at what is our total return, it is always the current return plus your capital return. But here in this case, our current return is positive, which is 1.67 percentage, whereas we are having the capital losses 6.67 percentage. But just because of this is positive value, it is actually suppressing the total capital losses. So here your total return would be somewhere 1.67 percentage minus 6.67 percentage, which would turn to minus 5% instead of this minus 6.67 percentage. So I hope you have understood how to calculate the total return. Moving ahead now, suppose you want to understand now the performance of the stock where you want to invest, and you have been given certain historical data of that stock. Here also we have been given the historical data of a stock from 2012 till 2022, where the values which we have been given, that is share price at the end of each of the year, and the same point of time, what is the dividend that company has distributed per share. And if I just want to calculate what would be the return from this investment. First of all, to calculate the return, we need to calculate what are the capital gains, as we have already been given the dividend values. So we have just jotted the all information that we have been given, which is share price and dividend per share. To calculate the capital gain or loss, we need to calculate what is the value at the end of a certain year minus the value of the share at the end of the previous year. So as far as 2013 is concerned, if you just want to calculate what is the capital return out of this investment, so it would be 166 rupees minus 138. 166 minus 138, which would give you 28.01. Already dividend values we have been given in the year 2013. So here the total return would be 2.20 plus 28.01. So it would be 30.21. To calculate the return for this particular year, the total return would be divided by the value at the end of 2012, which was 138.35. So this would give us the rate of return for a particular financial year, and it would be 21.84. Same way, if we just look at to the next year, we are having the dividend income of 2.90. At the same point of time, to calculate this capital gain and the losses, we are going to apply 225 minus 166.36, which would be 58.64. So total return would be 61.54. And here, the rate of return would be calculated as 61.54 divided by 166.36. So here the return value would be 36.99. If we just look at the 2015 year, here dividend is positive. But at the same point in time, if we just look at the value from 14 to 15, the values of the share have depreciated. So here, instead of the capital return or the gain, we are going to have a capital losses, which is 18.65. But just because of this value is positive, so total return comes to minus 15.15. And here, when we are going to calculate what is the percentage return that we have earned. So here, instead of the earning, we are having the losses of minus 6.73%. So the same method or the calculation we are going to apply till the last year, 2022. And based on that, we can calculate the rate of return which are occurring over the period of 10 years, starting from 2013 till the end of 2022. So here and there, we can see these fluctuations are there where some of the years are giving us the positive return, but some of the years we are having the negative returns like 2015, 2017, and 2019. The same has been depicted in this particular graph where all the orange bars are actually denoting the positive returns, whereas these brown bars are actually reflecting the capital or the total return where they are negative. Moving ahead. After learning how to calculate the historical or a single period return, now we are shifting our discussion to the average rate of return. So basically, what is this average rate of return? So when the multiple years or multiple time period we have been given, and we have been given the return value, at that point, if you want to understand how the particular asset is performing in the market, at that point of time, we are just going to calculate the sum of each of the return value that we have been given, divide that by the total number of years. So basically, arithmetic mean is nothing but the summation Ri divided by n, where Ri is the return value that we are receiving at the end of first year, second year till the nth year, and n is the total number of years that we are considering. If you just look at to the calculation of the same example that we discussed earlier, that is this, where we already have calculated what are the rate of return over the period of time from the year 2013 till 2022. And if I just want to understand, then what is the average return that I have earned out of this investment? So here, what you are going to do, you are going to calculate, first of all, the summation of all these returns divided by 10 periods. So if you just look at to the performance of this particular investment, it is 9.138%. So on an average, we have earned 9.138% over the period of 10 years from this particular given investment. So this is again a widely used tool to understand or calculate the performance of your asset. But at the same point of time, there is some limitation of the calculation of arithmetic mean. Sometimes it is not advisable to take the help of this simple average method while taking the decision in investment management. A critical issue of the management of the investment management, it is compounding factor, which has not been actually addressed by this arithmetic mean calculation. Just try to understand. Here we have been given, you are investing in a certain stock, say suppose in 2020 at the value 100. After a period of 1 year holding, in 2021, the value of that stock has reduced to 80 and there is no dividend income out of that. If I ask you, then what is your return at the end of year 1? So it is loss. 100 minus. Here, 100 rupees you had paid for buying this asset. But at the end of the year, the value is 80. So if we just calculate what is the price at the end and what is the price at the beginning, so it would be the capital return 80 minus 100, which would be minus 20. And if you just calculate what will be the percentage change of the return, so here here we are having the losses of 20%, that is minus 20 divided by the price at the beginning 100. Now you are holding further for more 1 year, and at the end of the 2022, the value of the stock is again 100. Now, in case if you are just calculating what is the change or what is the return over this next 1 more year, so over here this value at the beginning, which was 80 rupees, now the value is 100. So actually you can see the profit is there, 20 rupees. And if you just calculate what is the then total return over over this investment in the second year. So that would be 20 rupees divided by 80. So this would be 25%. And if I just ask you, so what is the arithmetic mean? So this would be minus 20 plus 25 divided by 2. That is summation Ri divided by number of years. So it is reflecting you are gaining 2.5% average return. Are you gaining anything out of this? You had invested 100. At the end of 2 years, you are gaining. You are again fetching 100 rupees. That means that there is no change in the value of investment. And at the same point of time, you have not received any sort of dividend out of this. So this is the limitation of arithmetic mean. But to overcome this limitation, there is one more measure, and which is known as the geometric mean. The advantage of using geometric mean is that it accounts compounding factor or cumulative return over the time in calculation. So it is used in the investment to reflect the realized changes in the wealth over the period of time. So how to calculate it? So here, instead of the absolute return, you are going to take the relative returns and you are going to calculate the nth root of the product resulting from this multiplying the series of the relative returns together. So now we are going to see an example, and the same example we are continuing with that, where we have already calculated the total returns in the earlier discussion. Now, as I mentioned, here instead of absolute return, you need to convert your returns into return relative. So how to convert that? If you want to calculate return relative, so it would be 1 plus decimal return that you have calculated. In our case, in 2013, our return is 21.84%. In decimal, it can be presented as 0.2184. Add 1 into that, so that would be 1 plus 0.2184. It is 1.2184. Same with 2014, but look at in 2015, instead of profit, we were having losses, and the loss was minus 6.73%. So here your decimal value would be minus 0.0673. When you are going to calculate the return relative at that point of time, it would be 1 minus 0.0673. So it would be 0.9327. So your return relative values cannot be negative. Now for the calculation of geometric mean, what we are required to do. So first of all, we are going to calculate the multiplication product of all the return relative values over the 10 years. So here this would be 1.2184, multiply that with 1.3699, multiply that with 0.9327, so till 1.0293, our last return in the year 2022. Raised to 1 by 10 minus 1. So here, the product of the multiplication of this values, it is 1.9799 raised to 1 by 10 or 0.1 minus 1, which derives to the geometric mean is equal to 7.07%. So we had calculated arithmetic mean of the same series, which was 9.14%. But here when we calculate this geometric mean, it is 7.07%. Okay. Yeah. Now here there is one data which is actually the data of Nifty from the year, we can say 2000 till 2022, and here the written values we have been given. Okay, so here The monthly returns are given, and based on that, the annual performance of the Nifty has been calculated. Okay. Now it's your practice time. You're going to calculate what is the return of the Nifty from the year 2000 till 2022. And you're going to calculate its arithmetic mean and geometric mean. Now, moving ahead, how to measure risk. Risk. Already we have talked about what is risk, but now we are going to look at the quantification of risk. So again, we are going to follow the same example, but just look at the data and what you are observing in this data. Lots of fluctuations. Some were plus, some were minus, and volatility actually in the value of the shares. At the same point in time, your dividend is also not constant, it is also changing one. So how do you measure these fluctuations? Now to calculate this fluctuation, generally we apply one tool, and that tool is denoted as standard deviation. This standard deviation is actually helping us to understand what is the variation in the return that you are expecting and the return that you are generating. So the statistical tool standard deviation would help us to understand this variation, this deviation. But to calculate this deviation or the variation, we need to calculate this statistical tool. We need to apply this tool on the given data. So generally, standard deviation is denoted as sigma. And to calculate that, first of all, we need to calculate what is the deviation of each of the written value from the mean value. Mean value is nothing but the arithmetic mean value that we already have learned. So to apply or to calculate the standard deviation, we are going to take the same example. Again, we are going to consider all the years. We are having the share price, we are having the dividend, we have already calculated capital gain and the losses, we have already calculated this total return in value term and in percentage term. So here, all these calculations are already been made. And based on this return value, we have also calculated what is average return out of this investment, which is 9.14% in our case. But to just understand the variability or the deviation, or to calculate the standard deviation and the variance of this particular asset or the share or the stock, first we need to calculate RI minus R bar. So to calculate this RI minus R bar, what is my first RI? So RI is nothing but the return values over the period of time, and this would be our mean average value. So the first deviation would be 21.84 minus 9.14, which would give you 12.70. Second would be 36.99 minus 9.14, it is 27.85. But when it comes to the negative return, at that point in time, this negative return is minus 6.73 minus 9.14. So it would turn to minus 15.87. So this would be minus, minus, plus. But your sign would remain minus, minus 15.87. Next one would be 10.81 minus 9.14, so 1.67. Again, here the negative returns are there. So minus 16.43 minus 9.14, it would be minus 25.56, and so on till the last observation, which is 2.93 minus 9.14. So this would be minus 6.20. To go further, we need to calculate the square of this deviation. So deviation values are already calculated. Just calculate the square of each of this value. So 12.70 and the square of that 161.26, 27.85 square value, 725.89. minus 15.87. When you are going to calculate the square of this negative figure, it would be minus minus plus, so it is 251.87. Like this, we are going to calculate the square value of each of this deviation value. And lastly, the summation. So the summation of this column, that is Ri minus R bar square, which is 4290.38, it would be divided by n minus 1. In our case, total 10 observations are there, so 10 minus 1, it would be 9. So that value, 476.71, it is giving us the variance value, and the standard square root of this 476.71 will give us standard deviation, which is sigma, and it is 21.83. So this is how the risk of the security can be calculated with the help of the statistical tool, which is standard deviation. So here in this lecture, we covered how to calculate the historical or the single period return with the help of current return calculation and the capital return calculation. We also covered how to calculate the arithmetic mean and what is the limitation of arithmetic mean calculation, geometric mean calculation, and lastly, how to calculate the risk of a given financial asset. I hope you have developed fair understanding about risk and return in the security in the share market. Thank you.